Jesse, one thing we've talked a whole lot about is the notion of the volatility tax.
Yeah, the way I best illustrate this, Chris, is, start with $100, lose 50%, you got $50. If what do you need to get back again? You need 100% return from what you have now to get back to even again. If you can short circuit that downside, you don't have to get all of the upside, and you can do as well, maybe even better, by avoiding volatility tax.
So you created two graphics here. The first is just a volatile investment in orange versus a less volatile investment in green. So like year one, the volatile investment was up 28%. The less volatile investment was up 18%. Obviously, you leave 10% on the table. You don't love that.
Don't love it.
But let's look at the next year. If you're down 6 versus down 22, are you better off?
Well, the ending value suggests that you are, and that's just math, right? That's all it is. And so if you can maintain a lower volatility throughout a 10 years, you can average the same annual return, an arithmetic average return, and still have less money. Because the geometric or compound average growth rate is better by avoiding those big down periods.
Yeah, so the CAGR on the volatile investment is 6.95, and this is hypothetical, but the CAGR on the less volatile is 7.8, right? Like, wouldn't you rather have 7.8 versus 7? I mean, you would.
All day long. And yet, again, portfolio managers would both say, I had an average return of 8%, and they both would be correct, but one ends up with more money. That's the concept here.
So let's look at it at an income production scenario. So what we've got is a 4% withdrawal on the same $1 million in both portfolios. And what you end up with in the volatile investment is about $445,000 in income and $1.3 million after those withdrawals. But if you look at the less volatile investment, what you end up with is a $480,000 income, so more income, and an ending value of $1,440,000. So, which would you rather have?
Well, over 10 years, I'd rather have $38,000 more of income and $100,000 more in actual value still. I mean, certainly, and that's the whole concept here.
So the bottom line is managing risk, managing that left tail matters, and you got to work with people who know how to do that.
That's right.